Hello, everyone. My name is Andreas Talastinos, and I would like to welcome you all to today's webinar titled Trend Indicators and Strategies. Let's go through the agenda for today. We're going to talk about trend. Trend is your friend, everybody knows that. And then we're going to define momentum, and we're going to see how momentum is constructed. And then another oscillator, which is MACD, also known as moving average convergence divergence. We're going to explain how it's calculated. And of course, we have to take a look at moving average, a very popular indicator in the markets. Everybody uses the moving average. And of course, we can combine these tools for higher precision. And a very popular strategy that was developed by Mr. Wells Wilder, a very famous technical analyst. We're going to describe it, we're going to explain it, and we're going to see how to use it. Of course, questions and answers anytime throughout the webinar. Anytime you have a question, just post it. My colleagues will translate the question for me, and I will try to answer it as soon as possible. So please type yes if you can see our presentation, and if you can hear my voice, please just type yes, okay, something so I know. Um, Give me some feedback, guys, please. Give me some feedback so I know that we are all in sync. Okay, all good, excellent. Let's go on. Thank you, guys. So what is trend? Is the direction of the market, of course, but this is a very general definition, right? It's a very general definition. We want precise definitions, and of course, we can define trend as the direction of successive tops and bottoms. Yes, this is a very good definition, direction of successive tops and bottoms. And I have to remind you that markets do not move in a straight line. They do not move in a straight line, but rather they follow a zigzag path, which is actually a trend. Very good. We go on and let's take a picture of a range. Let's take a look at this image where we can notice equal tops and equal bottoms. Let me just make a small note here. Even though every book, every article, every website talks about equal tops and equal bottoms, in reality, they are never exactly equal. And as you see on my image here, this top is higher than the previous top. And as you see, the bottoms are not really exactly at the same price level. And this is what makes range very risky, to be honest. So it would be very nice if we had an indicator, an oscillator that would tell us whether we are in a range or in a trending market. Imagine that if we had a system, a tool to tell us whether we are in a range. If we are in a range, then we can stay out of the market perhaps and avoid the risk. All right. So we have, what is that? We have a question already. The parameters used for these indicators when the market is in volatile and non-volatile mode. Thank you. All right. What is the parameter of the indicators when we are in a volatile and non-volatile mode? So let me try to attempt better to reply to this question. So when there is a volatile market, and actually, what is a volatile market? Let's start from the beginning. What is volatility or what is a volatile market? There are two ways to define volatility. The first way is that it's a market that is trending. We can say that it's a volatile market, as opposed to a flat market that goes sideways in a very narrow band. Are you following me, guys? So, if this is the definition of volatility that you imply or you mean, then I will give you the parameters as we described each and every tool. But if you mean volatility, what do we notice, what do we see during non-farm payroll report, then allow me to say that this is a very risky market and no parameter and will help you face this kind of volatility / chaos. Because in this kind of volatility where, for example, we notice in non-farm payroll report, rules are broken, breached, and violated. So what I prefer to say during these volatile markets, CNFP, is to stay out of the market, wait for the market to settle down, and then we enter fresh when we spot a nice trend. I hope I answered this question. So let's go to a trending market. So as I said, successively lower tops and lower bottoms define downtrend. Again, a downtrend is the direction as defined by successively lower tops and lower bottoms. You see, each top is lower than the previous one, and each bottom is lower than the previous one. This is the way to identify downtrend based on Charles Dow's theory. But perhaps if we had an indicator, a tool, a system to identify trend for us, perhaps for some beginners would be even easier. And this is what we are going to find out in a while. So I haven't described or I haven't talked about indicators yet. I will explain in a while few indicators for you. This is to reply to a friend of ours who is watching us. I guess the name is Siamak. Apologies if my pronunciation is wrong. Siamak. Yes, so I haven't discussed any indicators yet. Now, I have another question. How can we trust indicators? Since we know that they display a lot of delay. This is a question, another question. We know that indicators are lagging. How can we trust them? Yeah, actually, it's a very good question. And allow me to say that the primary indicator that we follow in the markets is price. The primary indicator that we all follow is price. We use other tools like indicators and oscillators to get confirmation or to filter the direction of the market that we identify on the price chart. All right, so another question here is, can we identify tops and bottoms with indicators? Well, yes and no. One more time, the question is, can we identify tops and bottoms with indicators? Again, the answer is yes or no. I know that there is a zigzag indicator available on MT4, but I'm afraid that it misses some crucial tops and bottoms. Unless you are a programmer and you can program MT4 through MQL4 programming language, then the answer is no. You cannot use any indicator to identify tops and bottoms unless you program a custom indicator to do that for you. So As we said here, this is a beautiful downtrend as defined by lower tops and lower bottoms. And then there comes a point where this last bottom fails to go lower than the previous bottom. It not only fails to go lower than the previous bottom, but prices go above the last top. So this is a reversal known as failure swing. Is a very popular reversal, even though if you Google failure swing, the information that you will get is about relative strength index. So again, we want to buy here, but it would be a very good idea if we had a confirmation or two by a couple of oscillators, right? That would give us more confidence. And this is what we are going to do today. So again, using tops and bottoms, we can identify this uptrend as defined by higher tops and higher bottoms. And this uptrend will continue to move higher and higher until this top here fails to go higher than the previous top. And not only it fails to go higher than the previous top, it also drops below the last bottom. So right here, it's the end of the uptrend and the very early beginning of a new downtrend. And we would like to enter here with a sell position, but it would be very, very nice if we had one or two confirmations from oscillators, right? And this is, of course, what we are going to learn today. Again, this is a reversal, which is called failure swing, and defines the end of the uptrend and the very early beginning of a downtrend. So if we don't have any questions so far, then we will move on to define momentum. All right, so we have a question here. By successive, you mean consecutive candles? By successive, I mean consecutive, but not candles. I mean consecutive tops and bottoms. Okay? And then we have another question here. I am new here. What is the meaning of an indicator? Indicator, oscillator, you can perceive these as tools. Let's say they are tools, and I will explain in a while. All right, let's go on. For the scope of this webinar, we can use the terms indicators and oscillators interchangeably. All right, so what is momentum? Momentum measures the rate at which prices rise or fall. Okay, momentum measures the rate at which prices rise or fall. Okay, we rather analyze the change in price than the price itself. It's becoming a bit complicated, guys, but I will explain in a while. The use of momentum is to confirm the direction of the trend, at least for the scope of today's webinar. It is a very important information that we can get from an indicator or an oscillator. All right, very good. So, general rules of interpreting the momentum. So I have to explain here for the beginners that oscillators have a baseline. Some oscillators have a zero baseline, like MACD. Some other oscillators have a 50 baseline, like RSI. And then, of course, there are other oscillators that have a different baseline, for example, 100 baseline. So when the oscillator crosses above the baseline, then it's a signal that the market is going up. And when the oscillator crosses below the baseline, then it's a signal that the market is going down. All right, let's go on. So let me show you how momentum oscillator is constructed. So let's imagine that this is a price chart. This price here corresponds to 20. Then we get another price falling that it corresponds to 18. Then we get another price at 16. Then 18 again, and then 20. Now, if we want to calculate a 3-period, I repeat, a 3-period momentum oscillator, then the formula goes like that. We take the closing price and we divide it by the closing price 3 periods ago in the past. And then we multiply by 100. So, for example, if 16 right here, this price here is our closing price, we have to divide it by 3 closing prices ago by 20 and then multiply by 100. So 16 divided by 20 times 100 is, of course, 80. So we plot here this dot that corresponds to 80. So the next closing price is 18 divided by 18 times 100, and obviously the answer is 100. And we plot this point right here. You see, the baseline for momentum is 100. Now, if I take this price, which corresponds to 20, and I divide it by 16 and multiply by 100, the answer, of course, is 125. So this is the way the different points, if you like, are calculated. And then a line connects all these points, and what you see, it's a curving line that looks something like that, that moves above and below the 100 line. Is it clear, guys? Very good. All right. Can you please continue more slowly so we can take notes? All right. I will do that. So the most important thing here to understand is that when this curving line moves above 100, then it implies that the prices will go higher. And when the momentum line drops below 100, then it implies that most probably prices will fall down. Okay? All right. So this is the momentum oscillator. Now, the most important thing that you can get out of interpreting an oscillator is the crossing of the midpoint line, of the baseline, as I just explained. And let's take a look at this chart here that I have for you. So this is gold. This is a real chart, by the way. And you see that gold has been going higher and higher for many years. And then please take a look at the momentum that has been maintained, has stayed above the 100 line. But when the gold reversed here and started going down, momentum dropped below the 100 line. And this is exactly how we are going to use momentum to confirm our analysis. For example, in this chart here, we see this reversal and we believe that the market will start going lower. Then we take a look at the momentum and confirms this analysis that we just performed, so we feel more confident to sell. All right, guys? Very good. MACD. This is another oscillator that we're going to use. MACD stands for Moving Average Convergence Divergence. Because it consists of two moving averages in reality, they converge. It means they come together, and at times they move apart, they diverge. That's why they are called convergence divergence. So actually, as I said, it consists of two moving averages, two exponential moving averages. The first one is 26-period exponential moving average, and the second one is 12-period exponential moving average. All right? So the difference between the two is what we call MACD, or moving average convergence divergence. And then we have another line, which is a 9-period simple moving average of the MACD itself, which is called the signal line. Don't worry, guys, I will show you the picture just now. Okay, so you see, this is our price chart. This is the 12 exponential moving average. And of course, we have another exponential moving average of 26 periods. Now, the difference between the two, which is actually 12 EMA minus 26 EMA, is what we call MACD. So if we take the difference between the two moving averages here, then we get the answer of minus 10. All right? Then here where they cross, obviously the difference is 0. And then we can take another difference right here, and the difference between the two is going to be 18 this time. And we have another crossing, which again, it makes sense that the difference is 0. So by connecting these differences, we get again a curving line that moves above and below the 0 line. Do you see? This is a 0 line. It's not 100. All right? All right. So MACD is the difference between 12 EMA minus 26 EMA. Of course, you don't have to calculate that. Everything is done automatically for you, but it's better to understand the calculations so you can trust these tools. And then, of course, if we take a 9 simple moving average of the MACD itself, then we get this dotted line, which is called the signal line. All right. Interpretation of MACD. Obviously, the crossing of the 0 line confirms the direction of the trend. So if MACD crosses above the 0 line, then we expect prices to move higher. If MACD crosses below the 0 line, then we expect the market to drop lower. So we have a question here. What time frame should we identify the method? So guys, the beauty of technical analysis is that it applies to all time frames. All time frames. All right, let's go on. And of course, we have another crossing between MACD and the signal line. This is a faster signal, but contains more false signals as well, right? It's faster, but has more false signals. Okay, let's take a look at it here. So again, the example of gold, you see that has been going higher and higher for many years, and then there is a reversal at the top, and then if you see these gray bars, this is MACD, by the way, and at this point here, they drop below the zero line. This means that MACD confirms that gold will move lower, will fall lower, okay? This is how we use MACD, the crossing of the zero line. Also, when MACD, like in this case here, drops below the signal line, drops below the red line, like in this case here, we get a fast signal that maybe gold will move lower. Yes, indeed, it moved lower. And another fast signal is this one here, for example, that warned us that gold might move lower. Yes, it's a faster signal, but also it includes many false signals. So perhaps it's better that we follow MACD itself when it moves above or below the zero line. All right, so we have a suggestion by our friend here, Hossein, to check momentum on oil. So let me move on our MT4 platform here, all right? And I can identify here oil. Do we have oil somewhere here? Let me see if I can find oil. Crude oil is right here, 57.09. And I can remove this indicator here. We don't need it now. And perhaps we can remove this one. And I can apply here oscillators and then momentum. Okay. So one more time, guys, I will move slowly. So on the indicators list, I click the indicators list. And then I move to oscillators and then momentum. It's in the middle of the list. I select momentum and the default period is 24. Now, the first time you use momentum, the baseline will not be there. So let me just click OK and see how it looks. You see, this is momentum, this blue line, but I cannot really see the 100 baseline. Again, the first time you attach momentum on your price chart, the baseline will not be visible. So what you have to do is to right click on momentum, select momentum properties, and then go to the tab that reads levels. Right? Are you following me, guys? And then I click on add and I type 100. I press OK. And here you see this gray dotted line, which corresponds to the baseline of 100. All right? 100 is the period of momentum is 14 and the baseline is 100. So you can see here, and I can go perhaps to a higher time frame, weekly perhaps, or 4 hours. It doesn't really matter. All right. So here on this top, let's take this top here. You see there is a beautiful reversal here. All right. I'm using crude oil on the 4 hour. Crude oil on the 4 hour. So I see that the market on this black candlestick will go lower, and then I check what momentum is suggesting. And I see that the momentum is moving below 100, so I feel confident to sell on this black candlestick. So this is what I'm trying to say, that momentum will confirm our decision to buy or sell. So if you take a look at this, okay, excuse me, let me just, if you take a look at this market here, you see that we have lower tops and lower bottoms. Do you see that? Lower tops and lower bottoms. And of course, these will continue to move lower and lower until we identify a reversal. And of course, when we identify the reversal, we will be needing a confirmation, and we can use momentum for confirmation. Do you see that the momentum moves above 100 at this point here? So perhaps at this point where there is a reversal right here, we feel more confident to buy. So in a nutshell, very briefly, this is the way we are going to use momentum to confirm the price chart, our analysis on the price chart. We analyze the price chart, we analyze the price itself, and we get confirmation from the oscillators, from the technical tools. So we have a question here, and Mr. Nasser says, in fact, indicators are for confirmation. Is it true? Yes, this is true. Indicators are for confirmation. We analyze the price itself, guys, not the indicators. Indicators are secondary to price. Price is the boss, right? And then we have another question here. MACD is therefore not a lagging indicator? And the answer is all indicators are lagging. All indicators are lagging, except volume, but volume is not available in Forex. So we use indicators and oscillators as confirmation tools. To be more precise, actually it's not confirmation, but it's filtering. What they serve, the purpose that they serve is to filter the reversal or the trend. Okay, let's go back to our, all right. So MACD, this is what we discussed a while ago. You see the gray bars fall below the zero line, which means that most probably we should expect prices to move lower, right? Now we move on to a very popular tool, which is known as moving average. Okay, so actually what we do here, we average closing prices. All right, this is what we do. And the sell signal is generated when the price falls below the moving average line, and a buy signal is generated when the price moves above the moving average line. Very easy. And let's take a look at this image here to understand it 100%. So you see that the prices move above the red moving average line, signaling an upward bias, positive outlook that the market will go higher. And indeed, the market moved higher. And then at this point here, prices fell below the moving average line. And of course, what happened is that we expected that the market will fall lower. And this is exactly what happened, actually. And this is what how we are going to use the moving average. We're not going to use it to generate buy and sell signals, but actually to confirm our decision to buy or sell. All right. Trend indicators, we can combine the trend indicators. Why? For higher degree of accuracy. Instead of relying only on price, we can use a couple of indicators or oscillators to get more confidence, confirmation, filtering if you like, of our decision to buy or sell. All right? So let's take a look at it here. We see this uptrend on gold again, and it's going higher and higher and higher. We identify here a reversal. This is a beautiful reversal as defined by this top here that fails to go higher than the previous top. And not only this top fails to go higher than the previous top, it also falls below the last bottom right here. Okay? Then we see that moving average, it doesn't really confirm our decision, but MACD falls below the zero line, and momentum also falls below the zero line, the 100 line, excuse me, the 100 line, which confirms our decision to sell here. All right, we can go to a live MT4 chart if you like, guys. Let me just move to gold. Gold is XAU USD, right? Oops. XAU USD. I can use the monthly chart, by the way, and let me just show you exactly. So do you see here that, all right, look at it. Do you see here that prices are moving higher and higher, and there comes a point that this top fails to go higher and prices fall below this bottom. Do you see here? Prices fall below this bottom. All right, if I use momentum, then I clearly see that momentum is below 100, confirming my decision to sell at this candlestick here. So now I feel more confident to sell. All right, guys? Also, I can use a moving average as well. For second opinion, if you like, I like to use 50 period and 50 period. I like to use a moving average of 50 period. And the method that I use is linear weighted. Linear weighted, apply to closing price, and then I press OK. So you see that here where I want to really sell, price is below the moving average. And once again, a second tool confirms my decision to sell. So now I feel confident to sell because not only price suggests that I sell, but also two popular indicators agree with me. And this means more confidence. Now I would like to introduce the ADX, the Average Directional Movement Index. Maybe most of you haven't heard of it, but please allow me to say that it's not only an indicator, it's a system on its own. It's a whole system on its own. All right, it's a system. It was developed by a very popular technical analyst, Mr. Wells Wilder. So let me show you exactly how to use it. So again, we have gold on our price chart as example. And ADX consists of three lines. The blue line, which is called ADX, the green line, which is called plus DI, or directional index if you like, and the red line, which is called minus DI, or minus directional index. Now, the beauty of this indicator, as developed by Mr. Wilder, is to show whether the corresponding asset that we see here, in this case is gold, whether it's trending or not. Remember, my first slide was about the range, and I said it's very risky to trade the range. And I said, imagine if there was a tool to alert us whether we are in a range or not. And of course, there is such a tool, and is known by the name ADX. Now, when the blue line is above the 25 baseline, then it means that the market is trending. But when this blue line drops below the 25 line, then it means that the market is not trending. When we say the market is not trending, it means that it's a range, right? So if you take a closer look at this blue line, you will notice that this blue line is not above 25. It's slightly below 25. And to prove that what I'm saying is correct, you can move to this corner here of ADX, where it shows this reading, which it says 24.98. 24.98, which indeed means that ADX is below 25. So when ADX is below 825, it means that we have a not trending market, which translates to range. Right? Very good. Now, we have two more lines here, the green line and the red line. We can use these two lines for timing to buy and sell. All right. So, for example, when the green line drops below the red line, like in this case, the green drops below the red line. Pardon me, guys. The green drops below the red. It's a sell signal. All right. And when the green rises above the red, it's a buy signal. But there is a prerequisite to do that. The prerequisite is at all times the ADX, the blue line, has to be above 25. So first we wait for ADX to go above 25, and then we look for the crossing between the green and the red line to enter the market. All right. So this is how ADX works. The default period is 14. This is the default period that Mr. Wilder preferred. Okay. We can go on, or perhaps we can go on the MT4 platform. I can remove this momentum from here. We don't need it anymore. And we can remove the moving average, and we can remove these lines, and we can attach by clicking on the indicators icon, trend and we select average directional movement index. All right, are you following me? Then on levels, if 25 is not there, you have to go ahead and add it, 25. All right, and then of course, this is what you get right here. Now, look at that. At this point here, please notice that the ADX moves above 25. So the first signal was given here when the green line crossed the red one. Do you see here? So we have a buy signal here, but we are not allowed to buy yet because ADX is below 25. So we can buy only when ADX rises above 25. So our buy signal, we are going to buy at this point here when ADX rises above 25, which is a very good signal actually, because we bought at about 300 US dollars per ounce, and then what followed was a very beautiful uptrend that reached the all-time high price of gold of 1,920 US dollars per ounce. All right? All right. All right, guys. So let's go back to our presentation. So this is how ADX works. ADX should be above 25, and then we take a look at the crossing between the green and the red line to find whether we're going to buy or sell. Okay? The anatomy here of ADX. So we make sure you understand the lines of ADX. All right. So signals. Let's take a look at the signals. So what do you see here? The first step in interpreting the directional movement system is to select a security with a high ADX reading. What does it mean? Before you buy or sell, ADX, the blue line, should be above 25. Above 25 means that it's trending. It's not in a range. Very good. So he suggested that the baseline is 25. So this is the decisive factor, that ADX is above 25. So what he thought is that currencies with a reading of ADX above 25 are more likely to trend. It's a matter of probabilities. Now, all right, let's take a look at it here one more time. Here we have a crossing between the green line and the red line. Do you see that, guys? At a closer look, please see that the green line here crosses above the red line, which is a buy signal, right? But you have to wait for the ADX, the blue line, to go above 25. So you can buy. Buy signal when ADX is above 25 and there is a crossing above of the plus DI, the green line, over the minus DI, the red line. So here is a beautiful buy signal. Now, what do you see here? We see that the red line crossed above the green line, which is a sell signal. But we are not allowed to sell yet unless the ADX, the blue line, crosses above 25. So when that happens, yes, we do have a sell signal. All right, is it clear, guys? And now, after we explain where to buy and how to sell, we can find a way to take profits. This is a very pleasant situation in the markets. We smile again and we start dreaming. Take profit. Let's take a look at that. So, we are going to take profit or partial profits, if you like, after we buy. And once more, we buy when there is a crossing of the green line above the red line and ADX crosses above 25. So we buy at this point here, and then we might start getting some profits when the ADX, of course, is above 25 and above both the green and the red line, and ADX starts dropping, starts falling. Do you see? Here in this case, ADX is above 25. It's above both the green and the red lines, and ADX starts to fall. So this is a good signal, according to ADX, to start getting some profits. All right? Very good. And let's take a look at the stop loss that ADX is suggesting. As I said before, this is a whole system on its own. All right. So, the way to use the stop loss in ADX is called extreme point rule. It doesn't really make any sense, but I will demonstrate exactly what it is. So, let me show you here on the picture so you can understand exactly. So you see, at this point here, we have a crossing of the red line above the green line. And ADX goes above 25. So at this point where the two lines cross, we can attach a vertical line to identify the extreme point on the corresponding candlestick. So since we are going to sell, the high of this candlestick is going to be our stop loss. One more time, there is a crossing between the red line and the green line here. And this is a sell signal because the red line crossed above. If we attach a vertical line, then we identify this candlestick. The high of this candlestick will be our stop loss. All right? Another example with a buy. You see the green line crossed above the red line. So it's a buy signal. If we attach a vertical line, then we identify this candlestick where we are going to buy. The low of this candlestick is going to be our stop loss. This is the extreme point rule. Excellent. So this is ADX. And of course, what are the advantages? It's a black box. What does it mean? It means that you follow certain rules and you cannot deviate from them, which means it's objective. You are not allowed to put your own personal input. So it protects you from your emotions that sometimes will cost you money. All right? And of course, there are some disadvantages. Maybe since it's a black box system, the trader has no input. The trader cannot decide on his or her own. cannot have an input to the system, and some people don't like that. It's an advantage, a disadvantage at the same time. And of course, another disadvantage, if you like, is the number of 20 or 25. Wilder suggested the 20 or the 25 baseline. And some people say, why? How did he come up with these numbers, right? So they consider the disadvantage, if you really think so. All right? Excellent. And of course, this is ADX, and I have a couple of questions, guys. Before I let you go, let me read them out loud. Sorry for my question again. As mentioned, market moves up, volatile and non-volatile, down, volatile and non-volatile, sideways. My question is, what parameters do we use if such conditions of indicators, moving average and oscillators in the anatomy of a trend? Godfrey. Okay, guys, let me explain. If there is a sideways market, I do not trade. I stay out. Why? Because it's very risky. So there's no reason to use any indicators in a ranging market. We forget that. If you are going to use ADX to identify the range or the trending market, you can use either 20 or 25 as the baseline. But if you really want to find out the parameters of the moving average, uptrend and downtrend, I use 50 period linear weighted moving average. I do not use simple. I do not use exponential. I use linear weighted moving average, 50 periods. For the momentum, uptrend and downtrend, I use 23 periods. I hope I answered this question. And one more question, the last one, can we use ADX below 15-minute time frame? The answer is yes. You can use all technical analysis tools on any time frame, any financial instrument. All right? But as you move to very low time frames, there are more false signals. And you have to keep that in mind. And I have another question. Actually, it's a comment. Let me read it out, please. Mr. Andreas, thank you so much. Really, I loved that webinar. It is an amazing one. I must attend all of your webinars. Love you, Dr. Andrea. Thank you so much, guys. Keep on checking your inbox, your email, because we are going to announce very soon our next webinar. Take care. See you next time. Thank you.